Today we are talking to Scott Campbell. I met him through Profit First. He's a fellow Profit First professional like myself. And his niche is chiropractors. He is a CFP, which stands for Certified Financial Planner. So Scott, you want to tell us a little bit about yourself and what does CFP mean and all that good stuff?
Sure. Well, first of all, I'm up north from you. I'm up in Canada. CFPs are worldwide, and we all kind of work in the same kind of way and capacity. But yeah, I've been in financial planning now for nearly a decade, and about 5 years or so ago, I decided to kind of get my CFP marks, which takes a lot of time and energy and education to get those CFP marks. And if you want to, we can talk about what it means to kind of be a CFP. But the one thing I find interesting around financial planners is that I think it's the same in the US as it is in Canada, that anyone out there can call themselves a financial advisor or a financial planner or an investment advisor. You can kind of use really whatever name you want. So I always kind of recommend to my clients that if you're looking to work with a professional, see if they have those CFP marks.
So that's a good brand to look for.
Absolutely. Just like if you're looking for looking for bookkeepers or an accountant, you want to make sure that they're well accredited and they have good experience.
All right. You ready to get to it?
Yeah. I love to answer some questions for you.
All right. So let's just kind of do an overview of just basic types of investments, kind of what you deal with and what you would, be a good place for somebody to start.
Yeah, for sure. When it comes to investing, I think you kind of already mentioned it. It's like, where do you start when it comes to getting into investments? Depending on where you're at in your career cycle, a lot of people put off investing probably a little bit longer than they should. They need to start sooner than they would. But when it comes to investing, there's a number of avenues that you can go. Like people have often heard of, like, I can buy a mutual fund, or I can buy a CD from the bank, or I can maybe get a brokerage account and buy and trade my own stocks, or should I just hold cash? Or maybe you hear some extremes where it's like, I should just go buy a bunch of gold and keep it in a safe in my basement. Like, there's a number of different ways that you can invest. Typically speaking, when it comes to my train of thought, when it comes to investments these days, is at the end of the day, it all comes down to being well diversified when it comes to your investments. And we can kind of talk about general philosophies here in a bit. But one thing that I've found really fascinating over the last 5 years or so is there's a lot of marketing around mutual funds, and mutual funds are good in theory. But a lot of people don't understand that there's kind of two ways of investing and having that diversification. There's what's called active investing, and then there's passive investing. So a typical mutual fund is generally considered like an active type of investment. So what that means, Dan, is that there's someone, whether it's in Chicago or in LA or in New York, they're sitting up in an ivory tower with a team of people, and they're trying to actively make moves in their mutual fund to try and outperform the market. Okay. Does that make sense?
Yep.
Where an a passive investment is something that's what's called an ETF, an exchange traded fund, where it kind of just mirrors, say, for example, the S&P 500, which is the top 500 US companies, right? Yep. So the difference there is that the fees are substantially lower. Like, you can get into a potential passive index fund for, say, 50 basis points, so 0.5%, where in some mutual funds, you could be paying upwards of 2 or 3%. But here's the interesting thing that I find fascinating that most people don't know, that whether it's in the US or Canada or globally, I'll talk about US here. I was just looking at these stats. Over the last 5 years, only 20% of actively managed mutual funds have actually outperformed the benchmark, the market. So 80% are underperforming the benchmark. So when I say a benchmark, I mean the S&P 500, for example. Okay. So why I find that so interesting is that the majority of people, you only have a 20% shot potentially over a 5-year period to be in that mutual fund that's actually going to outperform the market, which is why you're paying those higher fees. Yeah. So that's why I typically like to lean towards the ETF, more passive route. You can Google and active versus passive, and there's debates on both sides. but I'm kind of firmly in the passive camp of saying, hey, if we can get our fees down by even 1%, in a passively managed index fund, we're going to do great long term because we're going to keep that extra fee in our pocket.
Nice. So our ETFs tend to be more computer traded, if you will. They just kind of have, a margin of where they're going to let a stock run, and then if it triggers stuff, they'll sell it or buy more or something like that. How's that work?
Exactly. So it's, for example, if we're looking at an index fund that's kind of mirroring the S&P 500, throughout the year, they'll make some minor changes to that ETF based on, companies that move in and out of that S&P 500, but it's just basically trying to mirror that as closely as possible. So it's trying to be the benchmark. Like, it's not trying to outperform, underperform. It just is what it is. So you say, like, your question was more so like, are computers kind of like running these algorithms? You can set up a brokerage account and buy individual ETFs now.
Okay.
But that's kind of another layer of diversification when it comes to investing, is that you could log into a brokerage account and buy a single ETF fund, but then you might be solely invested in, say, US equities. And here's another kind of common investing mistake that I sometimes see, is that we kind of, have all our eggs in kind of, say, for example, the US equity basket, where you could be investing in other countries throughout the world, which means you would need different types of ETFs. Some global, some US, some Canadian. You might want to have some bonds and whatnot in there as well. But that can all be done online now. You don't even need to do that yourself. You can partner with some of these Robo platforms or a good advisor, and they'll build a portfolio for you, and it all takes care of itself in terms of rebalancing and whatnot. Nice.
So can we go further down this road and talk about investment philosophies? You kind of mentioned diversification, but can you take it from
I think my number one rule when it comes to investing is understanding that there's a big difference between speculating and investing.
Okay.
I think a lot of times when people think of investing initially, they think that it's going to be it has to be a gamble. Like there is risk involved in investing, of course, but there is a difference between the two. And I'll talk about the difference here. Speculating, for example, is saying, you get a hot stock tip from your brother-in-law saying, I just heard about this great company, you should go buy some of that stock. I can think of years past recently where there was some big craze around Bitcoin, for example. Up here in Canada, when marijuana was legalized, there was a huge rush to buy cannabis stock a couple of years back. Some people made money. Some people lost a lot of money because it didn't perform as well as they thought it would. But my rule around diversification at the end of the day is, something that I'll tell all my clients when it comes to the kind of, if we can sum up diversification in kind of a statement, is this: I'll never own enough of one thing to make a killing in it, but I'll also never own enough of one thing to get killed by it.
Got it.
That makes sense?
Perfect sense. Thanks.
So I think if we're looking at those two in separate baskets, speculating versus investing, we can forget the idea of, like, just because you want to start, investing it doesn't need to be speculation. It doesn't need to be you setting up a brokerage account and buying individual stocks. People can do well that way, but it also takes a lot of time, energy, and research to do that. Where if you're, I know your clients are primarily doctors and other healthcare professionals. What they do best is taking care of their patients. They might not have the time or energy to dedicate to doing a whole lot of market research and trying to buy individual stocks. And that's where you can leverage these ETFs, where I can just use a platform or work with an advisor to help me get into a well-diversified portfolio where I'm invested across a number of different companies across the world, and that'll just take care of itself. That's like kind of investing 101. It's very basic. It's kind of boring when you look at it kind of from a high level, but it works.
Nice. We're talking with Scott Campbell, CFP. He's also a Profit First professional. Today we're talking about just kind of investment type that we should kind of be aware of. So I guess the next thing I want to talk about, you talked about a Robo. So that's a form of a trader, I guess. When should we consider using Robo trader? When should we use a discount trader, a full service broker? What are the roles of all those type of, services to buy and sell?
Sure. For sure. I guess there's kind of two kind of areas that I look at. Like when it comes to like the Robo platforms, as I mentioned, I'm Canadian, so I'm primarily more versed with the Canadian Robo advisors, but in the States, I'm very familiar with Betterment. I have a few colleague advisors that use Betterment for some of their clients. It's a great platform if you just want to get started with investing, for example, where they can build you a simple portfolio of ETFs. With that, though, there's no advice, generally speaking. Like you pay low cost, but you're on your own to get your account set up your deposits. But maybe more importantly, you don't really have anyone to lean on to when it comes to like, is this investment portfolio actually attached to some sort of financial plan? And even maybe more importantly, when markets do have big fluctuations, like we saw just a couple months ago when we saw the big market dips at the beginning of the pandemic, some of us just need to have that third-party advisor to kind of lean on and say, hey, like, I'm kind of scared about what's going on in the markets right now. What should I do? And sometimes it just takes that advisor to kind of walk you off the ledge of saying, we have a plan. This is our time horizon. We don't need to freak out. Like, this is normal. It's going to bounce back. So I think if you're starting off, there's nothing wrong with kind of going to begin with, at least with a robo advisor. You can just get started that way. Okay. Where I think it's important to maybe transition to kind of a full service kind of advisor is what I would look for in the States anyways, is potentially trying to find a fee only advisor where they're generally speaking, they're selling their service as a financial planner. Because like I was talking to you offline here, Dan, when it comes to investing, the investment world has become very commoditized. Over the last 20, 30 years, it's really changed in nature. If you wanted to buy an ETF in the 90s or in the 80s, you had to find someone like myself, for example, to get that ETF. Nowadays, you can set up an account in 5 or 10 minutes and bam, you're investing now. So why would you need an advisor? Right. And at that point, it's saying, all right, I'm getting my foot into the investment world, but maybe my life has gotten to a point where there's another layer of complexity that goes beyond just my investments. I want to have a financial plan set up. I want to start thinking about retirement. I want to make sure that I'm managing my cash flow in the right way. Taxes get taken into consideration in estate planning. There's a whole lot more in the kind of financial planning world than just your investment portfolio. But if you're just looking to get started, a Robo platform is great. If you're looking to make that transition, find a fee-only advisor that can help you kind of put together a financial plan. And really their job is going to help you get clarity on your situation, understand what your goals are, start developing what that financial plan will look like to kind of give you some clarity of saying, here's where I want to be in 5 years, 10 years, 20 years from now. And if we put this plan in place, where can I be? There's going to be road bumps along the way, but at least you have a plan of where you are now and where you want to be in a few years from now.
Good advice. So you and I kind of work in the same niche. You're focused on chiropractors, and I have some chiropractors as clients and naturopaths. And I guess what I hear from them is they kind of see financial stuff very sequential. I got to get my business running better. I got to pay off debt. Then I can invest. And I guess if I was your client sitting down from you and you knew my business was kind of new and I had all this debt, what advice would you give me, or give me some things that I should probably think about before I either start investing or before I pay off all my loans or whatever?
For sure. That's probably the biggest area of question that I get when I bring on a new client is, whether they're brand new into business or they're just out of school, whether they're employed or they have their own business. A lot of them are coming out of school with a great deal of student loan debt. And then on top of that, if they want to start a business, they might need to take out a business loan. And that can be overwhelming when you start seeing potentially 6-figure student loan debts. And it's usually the first reaction is, I got to pay this down as quickly as I possibly can. That usually comes up, and it's interesting. Usually in most of my initial discovery meetings with clients, it's usually something that they're quite proud of, saying, I know I have this student loan debt and it's served me well. I now have this education and I'm going to be able to make a great income. And they're usually proud to say, I'm going to pay off the student loan as quickly as I possibly can.
Yeah.
However, there's two sides to that coin. You know, I kind of always look at, when it comes to financial planning, I kind of take a net worth approach in terms of where we're at now. What's our net worth today? And there's two sides of the net worth balance sheet. You got liabilities, and then you also have assets. If we're only just focused on reducing our liabilities, yes, our net worth is technically growing, but it's only growing on one side of that balance sheet. Does that make sense?
Yeah.
So I usually try and figure out this combination for a client of saying, how can we make sure that we're paying down student debt in the right way, but we're also building up our investments as well. And not just investments for the long term, but also, 3 to 6 month cash reserves for an emergency fund. Maybe you need to start saving some money for an eventual down payment on a house. And also putting away some money for the long term, even if it's just 5% of your income, for example. So I try and find this balance between the two. So, in any given period of time, we're still growing our net worth. We're just doing it in two ways. We're paying down debt, but we're also growing some of our net worth on the asset side of the balance sheet.
That's brilliant. I love saving. So the fact that you can do both.
Yeah.
And you end up kind of at the same spot, but I think you really fight the anxiety devils, that say, I got this debt, I need to attack it. It's really nice to have cash saved up.
For sure.
So how can my clients contact you? Can you work with my clients if you're Canadian? Do you have a website, social media?
Yeah, for sure.
How do we find you? For
sure. In terms of reaching out, you can certainly visit me on my website. It's www.alignwealth.ca. Okay. And on Instagram, I'm at alignyourwealth. And in terms of my capacity of working with some clients, definitely potentially on the financial planning front. On the investment side, we might need to look at partnering with an investment advisor in the US, because that takes US licensing. But you can see I have some amazing contacts in the States in terms of other advisors that I would highly recommend.
Again, as we're leaving this discussion, do you have any recommendations in terms of books or videos we should watch to kind of get our financial IQ a little higher?
For sure. I have 4 books here to the right of me that I thought I'd share, because they're probably my go-to favorites. And what's interesting is that I think a lot of people are intimidated by reading personal finance books, either intimidated or it's just, I know there's something maybe more interesting to read than something on personal finances. But all 3 of these books that I'm going to recommend are all fun and easy reads. They're not technical in nature. They're all kind of, I've enjoyed reading them all, and you don't need to have they're wonderful. The first one is something that I just read not too long ago, and that's The Psychology of Money by Morgan Housel. It was just an incredible read, just kind of around kind of behavioral finance. It was just a wonderfully, it's kind of a book on stories. I just thoroughly enjoyed that read. I actually just picked up a huge amount of copies for Christmas gifts this year. Some other timeless ones that I love, The Wealthy Barber. This one's The Wealthy Barber Returns by David Shilton. Wonderful book. I listened to this book on audio. And the reason why I say everyone will enjoy reading is because I just laughed so hard, because David is just so hilarious, but he breaks things down in such a simple way where it's so obvious and fun to kind of learn about personal finance in the way that Dave talks about it.
So what's the connection to the barber there? Tell me that.
This is his second book, The Wealthy Barber Returns. His first book was out in the 90s, and it was this early concept about working with a barber and him saving kind of 10% of his money for life. And now he's just this very wealthy barber, not a huge income, but just stayed true to these very simple principles. There's a lot more that goes into it than that, but his book is wonderful. Another timeless classic is The Millionaire Next Door, but there's a more recent book called The Next Millionaire Next Door.
Okay.
It's the newer version of that book, and it's wonderful as well. Wonderful in the sense that it kind of gives you an idea that not every millionaire is out there necessarily in the biggest household with the biggest, fanciest cars. And I'm not saying that are bad things to have, but one thing that I took away from that book is that you can't judge someone by the cover. Just because they're driving the nicest BMW doesn't necessarily mean that they are wealthy. They just had the income to pay for that potential BMW payment, for example, right? So it was just a wonderful read to kind of help kind of get your own mindset around, like, I want to be a millionaire, and this is kind of what the Millionaire Next Door does to get to that level. So another wonderful lead. And the last one is a book by Carl Richards. It's called The One-Page Financial Plan.
Okay.
Excellent book. Just to kind of get your head around kind of like, what does it mean to make a financial plan? And I've actually taken his theory of a one-page plan into practice for my own clients. Because a lot of clients, when they're thinking about financial plans, and if they've ever had the experience of working with a financial advisor, it's typically known that you'd get like a 2-inch thick financial plan with all these charts and graphs, and maybe it's leather bound or something like that. It works great as a doorstop. You can just put that down and keep your door open, and you'll never look at it again, because who would want to read that? But when you can get your financial life and your goals and your plan down to maybe 1 page, maybe we can expand that to 2 or 3, but call it an executive summary financial plan. Man, it creates power and clarity of knowing, here's where I am, here's where I want to go, and here are the action steps that I need to take to get to my goal. And that book will help you do that.
Nice. Yeah, I remember reading The Millionaire Next Door when it came out in the 90s, and my takeaway, especially with cars, was that the cars they drive, their cost per pound is really low. So they drive big, heavy cars that are safe and they're fairly cheap to operate. So yeah, no Lamborghinis, huh? So any last words of wisdom? Anything that...
Last words of wisdom. When it comes down to it, I think my final thoughts would be here. If you're kind of, whether you're just coming out of school or you've been in practice or in your career for a decade or two, if you feel like you should be further ahead, don't beat yourself up about it. It all starts with just starting. And when it comes to when we're talking to just investing, it's just starting right now. It's never too late. The eighth wonder of the world is compound interest. Yeah. And, the best time to plant a tree is today. The next best time was yesterday, right? So I add that backwards. The best time was yesterday, but the next best time is today. So it's just a matter of getting started when it comes to investing. But then when it comes down to it, like lean on whether it's a robo advisor or a financial professional. They're going to help you make sure that you have the right accounts set up, whether it be, a 401k versus a Roth IRA versus a traditional IRA. That's where sometimes you can lean on a professional, make sure that you're, doing the right things from a tax perspective. But you can't go wrong with just starting out and getting into investing in a very simple fashion using a robo advisor.
Thank you so much, Scott. I appreciate your words of wisdom. This is good stuff. So appreciate
my pleasure, Dan. Anytime you want to do it again, I'll be available for you.
All right. I'll look forward to conversation number 2.
Thanks, Dan. You take care.